Hello and welcome to another Paraplanners Assembly short technical video. I'm pleased to be joined by Elaine Cruickshank from Aegon, and today we're looking at Scottish rates of income tax. So let's start off with looking at who is a Scottish taxpayer.
Okay, so this can be a little bit complicated, but I will say that HMRC has detailed guidance on their website if you need any further information. So I'm only going to look at some of the brief rules around this because we've got a short session here, because it could probably take up a session in itself to look at this. So basically the individual has to be resident in the UK for tax purposes in the first instance in the tax year. So they have to qualify under that rule first of all, and then they also either have to have a close connection with Scotland. So broadly speaking, their main residence is in Scotland. However, if they don't have a close connection with Scotland, but they actually spend more time in the tax year in Scotland than in any other part of the UK, then they'll be deemed to be a Scottish taxpayer. Or Scottish parliamentarians are actually Scottish taxpayers. So, the ministers that sit in the Scottish Parliament, for example.
They're just automatically classed as Scottish, which stands to reason, really, doesn't it? So what income is going to be taxed at the Scottish rates?
Yeah, so it's actually limited, the income that's taxed at the Scottish rate of income tax. So employment income, including taxable benefits in kind, self-employed will be subject to the Scottish rate of income tax on their self-employment income, pension income and rental income.
Okay, and there are a few more sort of bands and rates in Scotland than there are in the rest of the UK, aren't there?
That's right. We've got effectively 5 bands in Scotland, and 5 rates of tax in Scotland, as opposed to the 3 that there are in the rest of the UK. We have, obviously, the personal allowance is retained, so that's the same regardless of where you reside in the UK. So it's the Westminster Parliament that sets the personal allowance. But then in Scotland, you've got the starter rate, you've got the basic rate, intermediate rate, higher rate and top rate.
Okay, and
as opposed to, obviously, you've got basic rate, higher rate and additional rate in the rest of the UK.
It makes the tax calculations a bit more complex, doesn't it?
It really does. It makes them quite complicated. So if we start, first of all, how do you identify a Scottish taxpayer? Well, Scottish taxpayers have an S in front of their tax code. So that's a way of identifying that you are a Scottish taxpayer. As I mentioned before, the personal allowance and other allowances, such as the dividend tax fee allowance and the personal savings allowance, those aren't evolved, and they are reserved to the UK government to set these types of income tax reliefs and allowances. And it's worth noting that the Scottish rate of income tax only actually applies to non-savings, non-dividend income in any case. So it is only, as we mentioned previously, earned income, pensions income that's subject to the Scottish rate of income tax. And basically it's only individuals that are subject to the Scottish rate of income tax.
So I guess trusts and beneficiaries from trusts in that respect are not going to be taxed in the same way.
So trustees aren't subject to the Scottish rate of income tax. However, beneficiaries can be subject to the Scottish rate of income tax, depending on what type of trust it is and what type of income we're talking about. So for example, if it was a bare trust and the trustees had invested in a rental property and there was rental income being generated, then the beneficiary under the bare trust would be subject to the Scottish rate of income tax if they were a Scottish taxpayer. Same would apply if it's an interest in possession trust. Again, if the life tenant is a Scottish taxpayer and the income falls within one of the non-savings, non-dividend income classes, so for example, again, rental income, then they would be subject to the Scottish rate of income tax. And if the trustees of a discretionary trust actually make a distribution to a Scottish taxpayer, then that distribution of income from the discretionary trust is subject to the Scottish rate of income tax. So the beneficiary, though, will get credit for the 45% tax that the trustees have borne in relation to that income distribution, but the beneficiary will be subject to the Scottish rate of income tax on income distributions from discretionary trusts if they're a Scottish taxpayer.
Excellent, thank you.
And then just a little sort of like reminder here as well. So for capital gains tax, the upper earnings threshold for national insurance and the level of applicable personal savings allowance and the calculation of top slicing relief on a bond chargeable event gain, it's the higher rate threshold that applies in the rest of the UK that would form part of these calculations. So it's not the Scottish equivalent, it's the UK rates that form part of these calculations.
Okay, brilliant. And does the marriage allowance still apply?
Yes, Scottish taxpayers can still qualify for the marriage allowance. So basically, if I just summarise what the marriage allowance is, a non-tax-paying spouse can actually transfer 1,250 of their personal allowance to their spouse that is a basic rate taxpayer in the rest of the UK. So as far as Scotland is concerned, if it's Scottish taxpayers, then the transferor has to earn less than 12,500, so they have to earn less than the personal allowance. And the transferee can only have income subject to tax at the starter, basic and intermediate rates. So effectively at 19, 20 and 21% of Scottish income tax. And they have to be a UK basic rate taxpayer in relation to the savings income. So it can, and I know it becomes quite complicated when you're looking at these different nuances, but it can still lead to a tax saving of £250 in the current tax year for Scottish taxpayers.
Okay, let's move on.
But it is worth bearing in mind, there's just one final niggly little point that I should highlight. If the recipient of that transfer of personal allowance, so the taxpayer that receives the benefit of that transfer of the personal allowance, if they're an intermediate rate taxpayer, so if they pay tax at 21%, they can only benefit from a 20% tax reducer. So they won't benefit from 21%.
I'm going to come back and watch this one again.
Sorry, I didn't mean, you can see the anorak in me's really coming out now. So.
Oh, that's tricky. Right, let's move on to the one that I see most questions about, and that's pension contributions.
That's right. So really, it starts off in the basic premise here is that Scottish taxpayers receive tax relief from pension contributions at Scottish rates of income tax. So if a contribution is made into a pension scheme that operates tax relief at source, then the scheme administrators will apply 20% tax relief at source. So that gets applied automatically. If we are looking at a Scottish taxpayer that pays tax at 19%, for example, then there's no clawback of the additional tax relief that will have been applied in relation to their pension contribution. So if, for example, they're a 19% taxpayer, but actually the scheme administrators apply 20% relief at source, there's no clawback of that additional 1%. And if the Scottish taxpayer actually pays tax at more than 20%, then they can claim additional relief via the self-assessment tax return. So if they're an intermediate taxpayer, that means they could claim the extra 1% via their tax return, or if they're a higher rate taxpayer, then the additional 20%, or if they're a top rate, then the additional 26%.
So that makes pension contributions just even a little bit more attractive.
It does. It makes them even more attractive for Scottish taxpayers. That's right.
Brilliant. Well, Elaine, thank you once again for sharing your expertise. Thank you for watching, and we'll see you again soon. Goodbye.